Excellent. Well, welcome everyone to this wonderful webinar from the Resiliency and Wellbeing Center here at GW. We are really thrilled to have one of our own here to help us through these uncertain times. I know we use that terminology a lot, but I do think it tends to describe where we are. So Dr. Irene Foster is the Director of Inclusive Excellence and Professor of Economics, Department of Economics, GW Columbian College of Arts and Sciences, or CCAS, if you know it better as that, and a member of the American Economic Association's Committee on Economic Education. Dr. Foster received her BA and MA in economics from the University of Madras, India, and an MS in management from the Krannert Graduate School of Management at Purdue University, and a Ph.D. from the Kelley School of Business at Indiana University. Her dissertation proposal won the Alden G. Clayton Doctoral Dissertation Proposal Competition of the Marketing Science Institute, and her doctoral thesis received an honorable mention from the American Marketing Association. She's a fellow of the Doctoral Consortium of the American Marketing Association. An expert in economic education and personal finance, Dr. Foster will share key principles of financial well-being and strategies to build psychological resilience in the face of economic stress during her presentation. And we were talking earlier about how the timing on this couldn't have been perfect, even though we had to reschedule due to illness. So we're just really glad to have you, and I will turn it over to you, Dr. Foster.
Thank you so much, everyone. I am so excited to be here and so honored to be here. Thank you for inviting me to talk about this important topic. I understand that I have about half an hour, so I'm going to jump into it. And I'm going to talk a little fast, if you don't mind. I've put my email address on here because we're all here on the same campus. So even after the talk is over, if anyone has any lingering questions or just wants to meet up for a coffee or something like that, I am more than happy to do it. So let's just jump right in and talk about what the economy is. I wanted to talk a little bit about the state of the economy and then talk about what our response to everything that's going on should be. So looking at the economy is like six blind men looking at an elephant. And each of the blind men is touching a different part of the elephant and then describing the elephant as very different things. So somebody touching the tail might say the elephant looks like a snake. Somebody touching the legs of the elephant might say it looks like a tree. So in economics, when we want to understand what the economy is, we have to look at a number of different economic indicators. And I've got some of them up here on the slide. We look at things like economic growth. We look at inflation. We look at the unemployment rate. We look at what's happening to interest rates. To fully understand what is going on in the economy. And all of those things, it turns out, affect our personal finances. And then what we choose to do with our personal finances in turn affects the broader economy. So if we all decide, for example, that we are now getting very nervous and we don't want to do a whole lot of spending, well, guess what? That in and of itself will affect the economy and result in less spending overall for the economy and cause the economy to slow down. So this interaction is very interesting. So what is economic growth? You hear about it all the time. You read about it in the newspaper. And what I want to show you is what the economy actually looks like is that wave-like pattern. You see the ups and downs. So if somebody were to ask you, is a recession coming? The answer is always yes. It is going to come because that's how the economy works. It works in cycles. So we just don't know when it's going to come. Is it going to come soon or is it going to come later? But it is coming. If somebody were to say to you, well, is there going to be an economic boom? The answer is always yes. It's going to be coming because the economy works in cycles. We just don't know when. So the wave-like pattern that you're seeing here, that is what we call, that is short-term economic growth. And you can see my arrow there is pointing to something called a contraction. That's also called a recession. And that is where the economy actually doesn't grow for a period of time. In fact, we're producing fewer goods and services in a period of time, less than we were in the last period of time. So that's what we call a recession or a contraction. But I really wanted to bring your attention to what the line that is going through the wave. And if you look at that line, that's what economists focus on. And that's what's called the long-term growth trend. So we know in the short term that there are going to be all of these ups and downs, and they're not going to be as smooth as what you're going to be seeing as what you're seeing on my slide here. We are looking at the long-term trend, and notice through all of these ups and downs that I'm showing you on my slide, that growth trend is still going up, and that is what we're looking for. So for the United States, when we talk about real growth, how many goods and services we're producing and the value of those goods and services, we grow at about 2%. And you might think, oh my God, 2%? That's so small. Is that all that we grow at? Is that our growth rate? And the answer is actually, we are a huge economy, and 2% of growth for an economy that is the size of what, $23 trillion? That is we are producing almost an entire whole economy every single year. So this is one of the things that we look at, and this is economic growth. The other thing that so how is the economy doing? Here is some recent data from Statista. Actually, the source of this data is from the Bureau of Economic Analysis. And I've given you a link to the Bureau of Economic Analysis here if anyone wants to go to the website and see the data that's produced there. So what I'd like to focus your attention on is the zero growth rate right here. So the zero line is what we're going to be focused on. Everything above the zero line is shown in blue, and that is growth. That tells us how much more we produce than the last quarter. So having something in blue, having the vertical blue line is a good thing. It says the economy produced a little more than we did in the last quarter. And notice the growth rate. It is at about 2%. It tends to be pretty low and steady. It's about 2%. And the things that we don't want are these things that are below the zero level, which are in red. And that says the economy actually shrank in that quarter. So let's take a look at an outlier here, 2020. And of course, everyone knows what happened there. It was COVID. And you can see everything shut down. Nobody was traveling. The economy shrank and shrank by almost 30%. But you can see how resilient the economy is. Once we figured out what we needed to do, once we all started masking, using hand sanitizers, restaurants started putting tables and chairs outside, and people figured out how to do things, well, the economy just bounced back the next quarter. So where are we right now? So if you look at the first quarter of 2025, it is actually below the zero mark. So the economy shrank a little bit at the beginning of the year. Economists were expecting it. And why did the economy shrink? What was actually happening? Well, it turns out two interesting things were happening. Consumers were pulling back, and where they were pulling back was on services. So for example, if it was somebody who really liked to get massages, they decided, oh, maybe this is not the time for me to be spending a lot of time on getting massages. And so they've cut back on services. But where the drop really came was that we all rushed out, individuals as well as businesses, we all rushed out to buy those goods from other countries that we thought were going to have high tariffs in very shortly. And so I myself noticed a lot of people driving new cars, around February, and there were just many more of them on the road than usual. Companies were stocking up on inventories. If they were buying things from other countries that they know were going to be under tariff very shortly, they were buying those things. So one of the reasons we see this big drawdown in GDP or economic growth is the fact that we were importing that much in the first quarter of 2025. So it's not necessarily a bad thing. It's just people's response to the expectation of tariffs. But we are keeping our eyes open to see what's going to happen this next quarter. But some of you might be thinking, but isn't the stock market doing great? We did have a blip in the stock market when Mr. Trump first announced all the tariffs. The stock market plunged. Markets were not happy about that. But then if you look at the data right now, you can see that in April, the stock market's rising to new highs and seems to be doing very well. Today, it dropped a little bit. Yesterday and today, the market dropped a little bit because of the announcements on tariffs on Japan and South Korea. But other than that, the market seems to be doing really well. So what should we think about that? The economy itself is shrinking. we didn't produce as many goods and services as we wanted or buy as many American goods and services as we'd want to, but the stock market's doing great, isn't it? So is this an economic indicator? And the answer is no. So economists do, we want the stock market to be doing well because many of us are invested. Our retirement funds are invested in the stock market. We want it to do well, but we really don't take it as an indicator of how the health of the economy. So why not? It's driven a lot by expectations. It is driven a lot by emotions. Some of what's going on in the stock market is based on the fundamentals of companies, whether they're actually making profits or not, whether their prospects look good, but a lot of it is also what we call animal spirits and expectations. And so we cannot treat that as one of the solid data points. Investors like certainty. Why did the stock market do so well? The back down on tariffs. And if any of you have been listening to the news, the deadline is actually tomorrow. New tariffs were supposed to kick in tomorrow, but Mr. Trump has already kicked that can down the road to August. So that backing down on tariffs and de-escalation of tensions with Iran and some hope that the Federal Reserve Bank will lower its interest rates have all, created some hope and positive expectations in the stock market. And so that's the reason we're seeing it going up. But economists, while we want it to do well, don't treat that as an economic indicator. One of the other things that you might be wondering about is the US dollar. And how is the US dollar doing? There's been a lot of news about the US dollar, and the US dollar has not been doing well. So here's a chart. The red line here is the US dollar. And you can see, again, we're going to focus on the zero line that's going across. How the dollar is doing against a basket of other currencies, the yen, the pound, the Canadian dollar, etc. You can see against those currencies, the dollar is not faring well. That drop that you're seeing, a 10%, almost 11% drop in the value of the dollar, is huge. How huge is it? Well, the last time the dollar dropped this much was 50 years ago in 1973, when the US dollar delinked from the price of gold. So that's how big this drop is. So why is this drop happening? What does it all mean? Mostly it is Mr. Trump's stance, the tariffs, inflation worries, and rising US government debt, especially given the bill that just passed on Friday. I also think there is, because of the America First idea, there is sliding confidence in the role of the United States as the center of the global financial system. So foreign investors and even American investors are looking for other options. Many of them don't want to be left holding the dollar if the value is going to be dropping. So what does it mean for you and me? Well, first thing it means is that if Walmart is buying a whole bunch of stuff from China or any place else, if the value of the dollar is dropping, Walmart has to fork out more US dollars in order to buy those goods. And then because Walmart is paying more for those goods, you and I are going to be paying more for those goods as well. So any foreign good that we buy in the United States is now going to be more expensive. And of course, travel abroad is going to be more expensive. If we're exchanging our US dollars for other currencies, we now will have to fork out more US dollars to buy those foreign currencies. And so travel abroad is also going to be more expensive. And by the way, this is separate from the impact of tariffs on prices. This is the impact of the value of the dollar going down on prices, and then add to this the impact of the tariffs as well. So now you're seeing a double hit on prices. So what about inflation? Inflation is one of the big indicators that we look at. And here is the US CPI-based inflation. CPI simply means that this is the basket of goods that you and I buy when we go to the grocery store. And you can see that there was a big increase in inflation. You can see between 2021 and 2022, how much inflation rose. We all felt it. We all knew it. It was almost at 10%. But the Federal Reserve has done a great job of bringing down the inflation rate. They do it by raising interest rates, and the Federal Reserve is our central bank. They raise interest rates, and you can notice how they've brought the inflation rate down. And now the inflation rate is at about 2.3%, which we think is pretty good. And you might be thinking, now, wait a second, this sounds this sounds a little suspicious. If inflation is going down, why are prices still going up? Why am I seeing higher prices in the grocery store and everywhere else? And the answer to that question is inflation rate and prices can be confusing. But if you see a positive inflation rate reported on in the news, it means that prices are going up. When we say the inflation rate is coming down, it just means the rate at which prices are going up is slowing down. So prices were going up at 10%. Now prices are going up closer to 2%. And so that is a big difference. We don't want that number to be negative. We don't want the inflation rate to be negative. That's something that we call deflation. And the answer to that question, to get the answer to that question, you're going to have to come and sit in on my macroeconomics class. So how the Federal Reserve measures inflation is slightly different. So when we look at CPI, it's everything that we buy. The typical consumer, we buy some healthcare, we buy some apples, we buy some gas, we buy all of the stuff, and it's those prices and how fast they're going up. But the Federal Reserve actually does not look at the price of food and the price of energy. Those are considered very volatile and based on things like conflict in the Middle East or weather somewhere. And so they look at everything except food and energy. That inflation rate is slightly higher. It's at 2.7%. And so what is the likelihood that interest rates are going to come down? Probably not much. Our target inflation rate, by the way, we do have an inflation target. And most countries have an inflation target of about 2%. We think it's a very low level of inflation. And if we hold it steady at that rate, the economy is stable. So unless they can bring it down from 2.7 to 2%, the likelihood is that they're going to either hold interest rates steady, maybe raise them, but I doubt that. But they will not lower interest rates until inflation rate goes down a little bit further. What about the labor market? What are we seeing in the labor market? Well, the labor market numbers just came out on Friday, and they are released by the Bureau of Labor Statistics. And they said that the unemployment rate in the US is near a 50-year low at 4.2%. Plus, it said American employers added 177,000 jobs. And usually economists think if the economy adds 150,000 jobs each time period, it's a good thing. So all of these numbers looked really good. So the question is, are the numbers really good? And unemployment tends to be kind of tricky. You can't take these numbers at face value. You actually have to dig deeper to see what is going on. So if we dig deeper, what we're seeing, what economists are seeing in the labor market, is that people are sitting in their jobs. And you might think, well, why is that a problem? Well, because in this country, we think that if I'm not happy with my job, I should be able to quit my job, move to another job, and I should be able to immediately be able to find another job and have that mobility. That mobility idea is really important in the US labor market. So the fact that people are just sitting stagnantly in their jobs is not sitting well with economists. Companies are also really not hiring. They're hanging on to the people. They're not firing a whole lot of their people. We've seen a lot of cuts in the on the federal side, of course. But if you look at private companies, there's not that much firing going on. On the other hand, ask anybody in the CCAS, our graduates this year are having a very hard time finding jobs. So what we're seeing in the labor market, the numbers aren't telling the whole story. The other big picture is that why is consumer confidence so low despite the low unemployment rate? And I'm going to show you that number in just a second, that chart. So it turns out if the labor market is so great, why aren't people happy with the jobs they have and what they're doing and how much they're earning? Well, it turns out that although people have jobs, the quality of those jobs is very poor. And so people are functionally unemployed. We call this functional unemployment. And we see that people who don't have full-time jobs and who want full-time jobs are still considered to be employed. And people who are not have a job but are not earning a living wage are still considered to be employed. And if you add those people in to people who are unemployed, well, then the unemployment rate jumps to closer to 24%. And now we're beginning to see the dissatisfaction in people and why people are saying they're not very happy or not very feeling very positive about the future. And is everyone feeling the way we're all feeling? And the answer to that question is yes. So this is the University of Michigan's survey of consumers. Economists are very interested in what consumers think. We call these expectations. And expectations really drive the economy. If I think the future is going to be bad, I'm going to cut back on my spending today. If I think the future is going to be great, well, guess what? I'm going to go buy a new car. I'll go buy, redo my kitchen, things like that. And so consumer sentiment really tells us ahead of time, it's a warning sign about what's happening in the economy. The last time we had such a large drop, look at my two red arrows on the screen here and here. This one was in 2020. This was the COVID drop. And people soured, their mood soured. They had very low expectations because of all the stuff, the scary stuff that was going on with COVID. And the second time we're seeing such a drop, this is a 29% drop in our sentiment, in consumer sentiment. And so what are they feeling bad about? They're feeling bad about prices, business conditions, job security, housing costs, access to medical care and the price of medical care, and what's happening to their retirements, given what's happening in the stock, all the uncertainty in the stock market. Over the 79 years of this survey, a drop this fast has always earlier predicted a recession. So this is kind of interesting data. And so these are all the indicators that we're looking at to see what is happening in the economy. The big question, is there going to be a recession? This is what everybody wants to know so that we can be prepared for it. So I've been reading a lot of stuff. I've been looking at what academic economists are saying, and I've was looking at what business economists are saying. I was listening to an economist at JP Morgan the other day, and everybody is predicting that the probability of a recession is going to be somewhere between 40% and 60%. I know you're all laughing because the average of that is 50%. So basically we're saying 50-50. There might be a recession, there may not be a recession. So nobody knows. Everybody is uncertain. The economy is running on the whims of one individual, and so it's very hard to predict what exactly is going to happen. But I do want you to note some things. The US economy tends to be strong and resilient. Even when there are recessions or crises, we tend to come out of them pretty strong. So think back to the financial crisis under Bush and Obama. Think back to COVID under Obama and Trump. The economy bounced back. Second thing I wanted to mention is that a recession doesn't necessarily need to be severe. We did have a little recession after COVID. That recession was about 2 months. It was a blip, and then we were coming back to normal. Many economists and both business and academic economists think that maybe we're not going to see a recession, but given all the uncertainty in the economy, that the uncertainty is going to be a drag on US economic growth. Now, remember what our target is. Our target for the United States, or what we tend to see in the United States, is about 2% growth. If we see 3% growth, we think that's icing on the cake. But now we think it might be closer to 0.5% growth. So it will be a drag on growth, even if it's not a recession. So what do we do? What are we all supposed to do? I love this quote from Lisa McGo, who is CEO and head of banking for Hong Kong and Shanghai Bank. And she said that she has been CEO of her company through 7 financial crises. And her take on this is never waste a good crisis. Use it as an opportunity for transformation. It is these kinds of situations exactly that make us rethink what we're doing and how we are running our lives, and to really change things up for the better. So let's think of this as an opportunity not to waste this crisis. You're going to think I'm crazy, because I said something about staying sane. And my first line on here is keep up with the news. And I will tell you that I have actually stopped listening to television news. I cannot stand all the talking. So while I don't listen to television news anymore, I like to read my news. And I like to read it at a time and place where it's not going to drive me crazy. But in order to manage your own personal finances, you have to keep up with the news. There's no way around it. And I would suggest multiple sources, getting various viewpoints. I listen to CNN. I'm sorry, I don't listen to CNN. I look at the news on CNN. I follow Fox News. I just want to know what people are saying about everything. And I like to get the full perspective, not just one perspective. It is really important to track the economy. I've given you links in the slides to the Bureau of Economic Analysis, to the Bureau of Labor Statistics that provides all of this data on GDP, unemployment, inflation. It's really just good to know. The Bureau of Labor Statistics website also gives you very good information on what is happening in the job market, the occupational outlook. I was just reading that the demand for coders is going away because AI can now replace a lot of the coding that's done, and AI can do it much faster. And so you want to know what is happening in the economy at all times and how the job market is changing as well. You have to learn about new financial products and fintech. There are so many new products coming out on the market. It's hard even for people who do financial literacy and personal finance to keep up with all that news. And I would say the biggest thing to keep track of is to read the news about climate change and the impact of climate change on your personal finances. Just think about what happened this weekend in Texas, the crazy floods. And if you think flood insurance is going to go up in Texas, well, it's not just going to go up in Texas, it's going to go up for all of us. Think about the fires in California. The impact of that is not just going to be on people in California. If insurance is going to go up, homeowners insurance is going to go up for all of us around the country. So these are some things to keep in mind as you think about your personal finances. Stay informed. If you have not been tracking your spending, if you've been doing what we call mental budgeting and thinking you're doing a great job with it, or if you're following something like a back of the envelope system, it's time to stop. It is time to change what you're doing. You've got to have a written budget clearly stating what your income is, what your spending is, what your need spending is, what your discretionary spending is. And if you're like me and you don't have the time to actually keep up with a written budget, use an app. So you can do digital budgeting. Here are some of the apps that I talk about in my class and that my students use. Rocket Money is a very popular one. You just connect your bank accounts and everything to it, and it generates a report for you at the end of the month or at the end of the week on how much you spend, what you spent it on. It will also help you with budgeting. Budget like your life depends on it. It does. If you really want to have control, this is a time where there's a lot of uncertainty. We don't have control over a lot of things, but this is something we can have some control over. So I wanted to share with you a budget worksheet. And this is one that I pulled off the internet, and I like this one a lot, and I'll tell you why. Here's a section where you put in your income. Here's everything that's taken out of your income, your federal and state taxes. I pay for parking on campus, so that's taken out before I get my salary. These are your big bills: mortgage, health insurance, car insurance, property tax, etc. So these are the big expenses. You could also think of them as non-discretionary or expenses or fixed expenses. All your debt, car payments, credit card payments, and so on. And then these are your smaller bills, utilities, medical bills, etc., subscriptions. And then this is a section called daily living, and this is what I would call discretionary expenses. And some of the smaller bills are discretionary expenses as well. And sometimes when you have to make cuts in your spending, this is where you'll make the cuts. So having these separated out makes it now very clear as to where you're spending. Here's why I like this budget. I like the fact that it includes a savings section. And it breaks down the savings section into retirement, into college fund, replacing your car, an emergency fund, and so on. And so this is a very good model for what a budget should look like. And I've provided it here. And when you have the PowerPoint, I hope you can pull this off. And if you've never done budgeting before, this is a very good place to start. What your budget looks like will look different for you based on whether you're a student, whether you're a senior couple with no dependents, whether you're a young couple with children. So here are some guidelines on how much should be spent on various budget categories. And there are other guidelines like this online as well that you can find, but this is one of the standard ones. So budgeting is hard. A lot of times, money is not discussed in families. There is guilt and shame associated with how much money people earn and how money is managed. So in lots of families, they don't talk about it. In lots of families, it's felt like you shouldn't talk about money. But I'm here to tell you, talk about it and talk about it loudly. And we tell students this as well, because students especially face a lot of peer pressure, but all of us do. No matter what level we are at, we all face a lot of peer pressure, and loud budgeting is a great way to control your expenses. So what is loud budgeting? Let's say my friends invite me to go bar hopping this weekend and say, hey, let's go have some fun and let's go bar hopping. And I say, hey, you know what? I'm saving for my new car. So I'm sorry, that's not part of my budget. So, I can go once a month, but I can't go every weekend. So I'm sorry, I'm not going to join you. That money's going to go towards buying my new car. And it leads to great discussions about personal finance. Now people are going to start talking to you about, oh, why are you doing and how much are you saving and, how long are you going to save, etc. I also want to say, don't give up if your budget doesn't work. Budgeting is a lifelong journey. It is not going to be perfect. You're not going to meet your budget all the time. And just go back and keep adjusting and readjusting your budget and see money management as a lifelong journey. There are periods when you're going to do well, periods when you're going to do maybe not as well as you would like, but just keep going and just do a little bit better next time. Here are some important things to know. Do you know your FICO score? And do you know that the US government allows you to get your free FICO score once a year from the three big providers of your scores? You can get it at MyFICO. You can get an annual credit report from TransUnion, Experian, etc. And I've given you the links. At least once a year, you should check your FICO, check your scores. My credit card company actually allows me to get another free score, and so a credit report. And so I like to check mine at least twice a year just to see how well am I doing? Is my credit score going up? And it is really important to keep that credit score up as high as possible. It means that you will get the best rates when you finally approach a lender for a loan. You are going to get the lowest rates possible if you have a higher credit score. Here are some of the things that go into your credit score. What is the most important thing that the credit reporters are looking at? They're looking at your payment history. Do you pay on a regular basis and on time? The second most important thing they're going to be looking at, and notice this accounts for together about 65% of your credit score and what your credit score is how much you owe. And so you don't want to take credit up to the limit. And usually we say you should take only about 30% of the limit that you actually have. They look at the length of credit history. I teach personal finance to freshmen, and I tell them that they should get a credit card right away. And many of them will say, well, my parents don't want me to have a credit card. They don't think I can manage it. So then we talk about how to talk to parents about getting a credit card, what sort of credit cards somebody new to credit should get, and so on. So length of credit history is very important. It's very important to get it as early as possible so that you can establish a credit history. And then the last two items on here are credit mix, not just credit cards, but also installment loans. So they're looking at a mix of credit and not just all the same type of credit, and not a lot of new credit. So if there are lots of inquiries for credit, if you're getting a lot of new cards, then that lowers your credit score. So this is something to keep in mind. Are you in control of your debt? Do you know the interest rate on your credit card? Do you know what the late fee is? And do you know what you're going to be charged? So it turns out I was looking at my credit cards, and on my credit card, the rate, if I don't pay in full, what they're going to charge me is about 21%. That is a very high interest rate. And on top of that, they're going to charge me a late fee if I don't pay on time. And that late fee is $40. And in the fine print, it says if I don't pay on time, my APR or interest rate will go from 21% to 30%. It's a big jump. So read the fine print on your credit card statements when you get them, pay your credit card in full and on time, automate credit card payments if possible. And if you absolutely cannot manage your credit card, this is why you need a budget. Now you go back to your budget, and there are two possibilities. Either figure out how to lower your expenses, so look at your expenses and see how to lower them. Or if that's not possible, the other option is to figure out how to augment your income by taking on a second job, doing a gig. This is something that you have to figure out. But this kind of control of your finances is what is really important. How do you lower spending? We talk about this a lot in my class. Buying things when they go on sale. So we don't buy summer clothes at the beginning of summer, but maybe buy your summer clothes at the end of the summer when they go on sale, and then you will have them available for next year. Buying things in different places. So if you're going to be buying toilet paper in bulk, for example, maybe you want to buy it from a big store where you buy in bulk. Buying store brands versus national brands. So instead of buying Del Monte brand at Walmart, buying the Great Value brand, which is Walmart's private brand. How many of you actually look at unit prices? Did you know on every single shelf in the grocery store, unit prices are listed? You have the full price for the good, but also the price per ounce or the price per pound. And think about the last time you actually looked at that when you shopped. Where to cut? Here are some options that we talk about. Cooking at home instead of eating out, cheaper entertainment, avoiding using your credit card, no more food delivery. There are numerous options that are laid out here, but I also want to challenge you. It's not just about cutting back on your spending, but maybe completely changing the type of spending you're doing. For example, I decided to maintain my sanity. One of the things I really need to do was to exercise more. And it was very hard to motivate myself to just go out there and get the exercise, the amount of exercise I needed. And one of my children had been pestering me to get some personal training. And I thought it was so expensive, I can't afford it. And then I thought about it completely different. I stopped thinking about it as an expense, and I started thinking about it as an investment in myself. And that completely changed my thinking. So it's not just about lowering expenses necessarily, but also thinking about how to change the way you're spending and investing, doing investment spending rather than just buying stuff. This is my last slide, and then I'm happy to answer any questions. Save, save, save. So the whole point of budgeting is that you can save. Saving is really hard. It is not easy for anyone. So the easiest way to do saving, and this is what I do, is to automate it, because then you don't have to think about it. So if I get my salary coming into my bank account, and then I've got to figure out each and every month, like this month, how much am I going to put away towards my savings account? That is a painful decision. But if I make the decision once and decide this is how much is going to go into my savings account every month, and I automate it, the minute my salary hits my bank account, that money immediately is moved into savings. So I am not making the decision over and over every month. It is automated. And I don't even feel it. Now I forget about it. I've actually forget that the money is going into savings. So when I see the money that's in my bank account, I think, oh, so that's just, what I have to spend. And then when I look at my savings account, I'm pleasantly surprised sometimes by how much is sitting there because I actually am not thinking about it anymore. It's automatically just going into it. So when we talk about savings, there are actually several different types of savings that we want to be doing. Savings account, first of all, is for large expenditures. Maybe you want to buy a car. Why not save for it? Why take out a car loan? So start saving for it bit by bit. Or you want to go on a nice vacation. Why not save for it instead of putting into your credit card? Really change your thinking about these things. Why pay interest to someone else when you could be saving and earning the interest yourself? An emergency fund is a separate savings account. So the guidance used to be that you need to have at least 3 to 6 months of your salary put away in an emergency fund in case you lose your job. And the idea was it might take you about 3 to 6 months in this economy to be able to find another job. Well, the guidance has changed, and the guidance is now to put away a full 1 year's worth of your expenses or 1 year's worth of your salary. So that is a large amount. So this is an amount, the emergency fund is something that you're going to build little by little, and just over time, that emergency fund is going to be filled up over time. The third type of savings is for your retirement account, which most of you are doing because you're a GW. But do you know what the GW employer matches? Are you putting in the full amount into retirement? Do you actually know how much of what percent of your income GW's employer matches? This is a no-brainer. If they're going to pay, okay, that number is 4%. So if you have a 401 retirement account, GW matches up to 4% of your income. So you want to make sure you're at least putting in 4% of your income into your retirement account, and then GW will match that 4%. If you have a 403B, if you put in 4% of your income into the 403B, GW is matching it at 6%. And so again, you want to take advantage of that full amount. So these are some basic guidelines that we need to follow and have these 3 different accounts. The final thing is planning for the future. So having a baby or planning to retire. If any of that is coming up, a lot of us think, well, we're basing it on 10 years ago. We thought we had enough in our retirement account, but then we're not accounting now for all the inflation that has taken place, the uncertainty in the economy, housing costs, how much that has gone up. And so everything needs to be looked at least every 5 to 10 years in order to make sure that you're planning ahead for your future and that you have enough put away for the future. One of the people that I work with, Anna Maria Lusardi at Stanford, always likes to say, we are our own CFOs. We are our own chief financial officers. And I just want to reiterate that statement. And thank you all for having me today. And please reach out to me if you have any questions. I wasn't sure we would have time today, but my last 4 slides are on the one big, beautiful bill that was passed on Friday. And some of it that concerns us, is there going to be a tax on Social Security? What's happening with student loans? What is going to happen to Medicaid? So some of that information is in my last few slides. If there are any questions, I'm happy to answer them. Thank you.
Thank you very much. Yes, please go ahead and put any questions you have in the chat. This is wonderful. I've heard the "you are your own CFO" statement before, and I personally love it. It's empowering. It's like I get to
It
make the
is very
decisions about my
empowering.
life, right? Sometimes we can get very much in the, oh, I'm so limited. This is all I have. And well, there are things that are actually limited, like your current salary, that you could go get more money. All right, you could go somewhere else, but your current salary is limited. But what you do with that money is entirely up to you. And I think many people, probably all of us, spend our money fairly mindlessly, and it
Yes.
just kind of disappears. You're like, where did it all go? Whereas if you sit down and you actually plan it out, you're spending it on the things that you value.
Yes, that's exactly right. I have my students do this exercise in class where I ask them just to track their expenses for 1 week or track their expenses for 2 weeks. And they are so shocked because they're doing the mental budgeting. And so they're so shocked when they look at it, the amount of money that they're spending on subscriptions and the amount of money that they're spending eating out, even though they have a meal plan on campus,
Oh, yeah.
over and above the meal plan, how much they're spending on eating out. So we talk a lot about and then they're like, I can see now that I'm spending too much on this, and then they get rid of some of their subscriptions. They limit how much they go out to eat, and then we develop a budget. Once they have an idea of like what their cash flow looks like, then they start building their budget, and then we come to March, and then they blow their budgets because it's spring break. So they
Right.
spent
Yeah.
way more than they thought they would on spring break. And then when we come back in April, we talk about how we didn't plan ahead for spring break. And so it's just a wonderful exercise. And it also teaches
Yeah.
them that budgeting is a thing that you do bit by bit and you get better and better at it. You're not going to develop this perfect budget right away.
Absolutely. Yeah, and that's another good point. I think many of us will do the same. We're like, oh, there's this opportunity to go somewhere, and we didn't include that in the budget, but we don't want to turn it down. Maybe it's a wedding, something that you really couldn't have planned for. But if you already have, my husband and I started a travel fund now that we put
Yes.
money into every month, and now we know this is how much money we have to spend because this is what's in our travel fund, and it's not going to take away from anything else.
Yes. It's a wonderful feeling to have that money put away and have available.
We do have some questions now. Okay. What do you think is best to do during the current economy? Invest in domestic or foreign stocks? Should our 401ks and mutual funds contain more foreign than domestic companies? That's a great question.
That's a great question. And the stock market is actually doing really well. The US stock market does really well. And on average, if you look at the last 10 years, I mean, the return from the stock market is about 12% or something like that. So it depends on what you're doing. I mean, if you are investing with any of the GW companies, Fidelity, Vanguard, and I have money in TIAA CREF, they manage the funds extremely well. They're great companies and they're doing a great job managing our money. So they are making those decisions for you. You can go into, for instance, I've gone into my TIAA CREF fund and I can choose some funds. I tend to like, socially responsible stocks or, because I'm from India, I like to, invest in some India funds, things like that. So you can make some of those choices yourself. But believe me when I tell you that your manager is probably doing a great job. And if they think that foreign stocks are doing really well, they're already investing in them. But you can also go in and make those changes yourself.
Great question. Another question here. Can you recommend what's the best way to get out of credit card debt? And same question on if there's a recommendation on reviewing student loan debt with the various government programs.
So credit card debt is a tough one. But I have a brother-in-law who is great at negotiating. And he has taught me that you can talk to credit card companies. If you have a lot of credit card debt, you can just say, what are you willing to take? And over what time period? And you can really bring your credit card debt down. So you can get it cut in half. If you can talk to them and negotiate it, and you can say, this is all I'm willing to pay. And it helps to be a good customer, but you can also say, I'm a regular customer. I've always worked with you. So you can bring it down and then work out a payment plan with them. So that I would definitely do that. I had an interesting situation last year. I am pretty good at my personal finances, but there are time periods when I get extremely busy, and we had taken out an installment loan to get some work done on our house. And it was a no interest loan if you paid it back in 2 years. And I'm like usually really good about these things and make sure everything is paid off on time. But I think we were on sabbatical or something like that. And I forgot the last two payments on that,
Oh,
on the installment loan. And so Wells Fargo came back to me and said, you owe $10,000. It was just like the sudden financial shock. And this is going to happen to all of us, no matter how good you are at managing money. As you get busier and busier sometimes, if you have kids or somebody falls ill in your family, this is going to happen. You will have this little a financial shock. And of course, I was so mad at myself. But then I thought, okay, what would Bill do? He would call Wells Fargo. So that's what I did. I called up Wells Fargo and I said, come on, I'm a great customer. And, I've paid on this thing. It was just the last two payments. And what can we work out? And I knew I owed them something. I knew what the contract was. I knew what the deal was, and I hadn't kept the contract. But I was so shocked. They immediately came back and said, okay, you owe us $5,000. They just cut it in half. And I have an emergency fund. And so I had the $5,000 in my emergency fund to pay for that. So it was bad. It was not a good thing. I don't recommend any of you do this. But these are the kinds of financial shocks we all face. And so it is really helpful to know how to deal, but negotiate, negotiate, negotiate. I can also provide, the Consumer Financial Protection Bureau has some guidance on its website on how to negotiate with credit card companies and so on.
That sounds very helpful. And I feel like the moral of the story is that what does it hurt to ask, right? Very, very low risk.
Yeah.
Excellent. Well, thank you very much. I don't have any more questions. I feel like you did a wonderful presentation, and hopefully people are feeling at least a little bit more comfortable and a little more empowered that, you're your own CFO and you can decide how and when you spend your money.
It is not an easy time. It is not an easy time. But it is good because it really causes us to rethink everything. So if you are someone who is complacently going along, thinking your finances were doing great, suddenly you're thinking about retiring, the stock market is falling. So then there's a little shock. So it is really helpful to think about these things ahead of time and make sure that you really know where your money is going and that you have control of the little. We may not be able to control a whole lot that's going on out there, but we can control our own personal finances.
Wonderful. Well, thank you so much for your time. We really appreciate it. And this recording will be available so we can send it out to everyone to share with their friends and family. I know Dr. Foster's mom's looking forward to the recording. Thank you so much.
Thank you so much. Yeah, I'm very nervous about my mom looking at this.
Hi, Mom.
Bye, everyone. Thank you so much.